Hey everybody, it's Jeff here once again with our weekly market update with Tom Kemler with BK Wealth Consulting. So this is a new old way of doing this. We actually decided to change the date that we publish these out, where it allows us to encompass a little bit more of what's going on during the weeks. So you'll see this come out typically on Wednesdays every week. So other than that, this week, what we're going to talk about is the Evergrande situation. It was the biggest thing really in the news going on all week that probably most people didn't even know what the heck it was. In fact, I had several friends that saw it up on the screen and were actually Googling what the heck Evergrande was because they didn't even know what it was. Apparently, they didn't watch our show the week before. Marginally positive economic news that we're going to hear this week. We've got some good things and some kind of things going on in the economy. And this week, we will not have a most interesting thing, but there is a most interesting thing, but we don't want to talk about it. So hang on. We'll be back here in just 1 second. Hey everybody, it's Jeff here, and welcome to our weekly market update with Tom Kemler. And Tom, how you doing, my friend?
Tremendous, Jeff. How are you?
I am awesome. Looking forward to your conversation today regarding our friends at Evergrande. I know you put in a lot of work and effort on this one this week.
Well, thank you. Yeah, it was last week's most interesting thing. It started off this week as very much the most interesting thing, which you were alluding to. So
it was unknown most interesting thing the week before, and it became the biggest story on the block this week.
Well, it's a property developer in China, and the numbers are all over the place. I've read everything from their outstanding debt is $50 billion to $330 billion. So
the scary thing is people don't know how much it is. That's the really scary part.
Well, even in our country, that there's all sorts of stuff. I mean, that was one of the things that we found out with Enron and a few other things, that there can be off balance sheet items. And so, I don't know exactly how big the Evergrande situation was, but, the statistic that stuck in my mind from last week that's worth repeating is that if you took all of the property that they have under development, and it would be equal to 3/4 of the island of Manhattan. So it's a giant thing. And in dollar terms, if the 335 billion is accurate, it would be twice as big as Lehman Brothers was when it failed.
Wow.
Now, the thing that happened, and I know some of our regular viewers will be reminded of this. Whenever I get into kind of a crisis situation, when the market gets into something where it's focusing on something, you got to at least dig in and understand what the cadence is. What events are going to happen? When are they going to happen? What the likely outcome or reaction to those events is going to be. So with Evergrande, because they have so many bonds outstanding, they're so indebted that they're going to have every month, at least several days every month, they're going to have to pay somebody something. And this week they had two days, one on Tuesday and one on Thursday. And it was last week that there was this concern that they had basically come out and said that we don't have the money to do any of that next week. So
we're just not going to pay you.
Yeah. Now that I want to tread the line here between not getting too far into the weeds and giving people enough that they understand. So, with any kind of failure situation, you start to fall back on, what are the securities laws? And in the United States, we have not only securities laws, we have bankruptcy court precedences, and it's a fairly understood process. Is it a Chapter 11? Is it a Chapter 7? And so these paths are pretty well defined. China doesn't really have any of that. They don't have any real precedent for allowing bankruptcies. They don't have a process in place. So they're kind of making it up as they go along. And I think everybody freaked out because, and I made it last week's most interesting thing, because the Chinese, the Global Times, which is essentially their international mouthpiece, had come out and said, we're not going to bail them out. And the company was like, well, we don't have any money. And everybody was like, whoa, this looks like a major train wreck. So on the Monday, we had a rough day. We were down almost 1,000 points at one point on the Dow. And everybody was looking at China, and what they had a fairly minor debt payment due on Tuesday to what they call their onshore bonds, or the local people's bonds. So they've borrowed money everywhere. They've borrowed money within China, which everybody refers to as onshore, and then they've borrowed money outside of China, which they refer to as offshore. So they had an onshore bond payment on Tuesday and an offshore payment yesterday. On Tuesday, they came out with this vaguely worded filing that said that they had negotiated payment with some of the onshore people. Didn't really say what was negotiated, didn't say what the bondholders took, didn't indicate whether or not they'd had to accept less than they wanted. Did they have to accept a new security with a lower interest rate, a longer maturity date? Did they have to accept payment in kind, like, title to a property? Nobody really knows, but they basically just kind of said, yeah, we paid it. We talked to some people and we paid this. And then yesterday they had another deal, but this was offshore. And so they didn't pay the offshore people. Now, again, back to the cadence, there's a 30-day grace period on these bonds. So they can pay up to 30 days late and still be in compliance, and the bond isn't considered defaulted. In the meantime, the reason why it appears that this was a one-day wonder is that what the Chinese government made clear after Tuesday was that they may not be nominally in charge, but Evergrande is not going to be able to do anything or not do anything without the explicit sign off of the Chinese government. And that's absolutely clear to everybody. And what is clear also, especially when you talk about the Chinese government, is that they're masters at making things not clear. So, and they can make up the rules as they go along. So it appears like what we're going to see is, the classic duck going across the pond. He appears to be, serenely traveling from one side to the other, but underneath you see the feet are paddling furiously. Behind the scenes, everybody is getting a talking to. The suppliers to this company are probably being pressured to accept less. The company is going to be pressured to make sure that they can, eliminate their profit margins altogether to move property to satisfy homeowners. So there's going to be just a lot going on in the background. And I think, while, in the United States, we would have just this big event that would be, it's a failure. And then is there a bailout or not? And it would be like one thing. And again, I think I'm speaking for the market. What everybody saw this week and what the Chinese government made clear by not being clear was that we're just going to bounce through this thing. And, if we got to peel off a few bills here and there as these various debt maturities come due, then that's what we're going to do. We're going to be working with everybody to make sure that maybe they don't, maybe they can accept payment in kind to have their bonds retired. And they're going to literally bounce through this. And it's going to numb people eventually, because with as many bonds as this company has outstanding, events like the onshore and offshore bonds, there were two of those this week. There's going to be several a month for the next 5 years. So there's always going to be this drip, drip, drip of, where are they? And
very difficult to raise any more capital at this point.
No, they're not raising any more capital. That's one thing that they're not going to do. But I mean, the thing that is, I think what the Chinese government wants to do, they're going to punish these guys. This fits perfectly with what Xi Jinping has been trying to do with some of the tech billionaires and some of the other. They've got income inequality concerns. So this is perfectly teed up for the Chinese government to make an example of these guys. And the people who are billionaires, like the one guy who created the company. I read last week that he had received $5.3 billion in dividends from this company since when the stocks that he holds since 2018, when they instituted a dividend. That's going to all be, if it's not already, the Chinese government is going to claw all of that back and use it to pay down stuff. So there's going to be stuff like that going on. These guys will probably end up in jail, but they're going to, be puppets out on the stage for a while as they move this thing along. It's important to note, there was a side story of this. Before this Evergrande, the biggest failure in China was a company called HNA. And one of HNA's, and that's been seized and taken over by the Chinese government. It was hotels and travel company. One of its top executives and founders died mysteriously last year. I think they just put the other guy in jail like yesterday. So this is all just kind of, just what's going to be going on in the soap opera that is Evergrande. But I think they're just going to be kind of rattling down, kind of like doing some whitewater rafting. They're going to, maybe bounce around a little bit, maybe have some backspins. Maybe you have to peel off some money here and there to keep everything going. But ultimately, what everybody's looking at is that this isn't like a Lehman Brothers in the sense that Lehman owed a lot of money, but what did Lehman have? Lehman was all paper. And so this is a company that at least there's properties that underlie this. Now, these properties could be overpriced. There could be all sorts of financial shenanigans, embezzlement, whatever, that means that the value of those properties isn't worth anywhere near what the money they owe is. But they still have a lot of properties. And so
they have physical assets.
There's a tangible asset offset here that, and I think that the Chinese government is just going to sit on the whole thing and grind it out and make sure that it doesn't get to be a scene. and simultaneously wagging their finger at every other developer that might be even close to being this lever to say, guys, it's time to not take dividends. It's time to not, you need to be paying down debt. And we'll see where we go with that. But, for now, everybody kind of collectively came to this conclusion over Tuesday, Wednesday of this week. And so unless something, just some sort of trap door opens up and just the bottom falls out, I think that this was the resolution. So anyway, I'm going to share the screen now. This is what Monday looked like from Evergrande, which is this was as bad as it got, right around here, and then we did rally a little bit on the close. This is the Wall Street Journal today, which I always love this. This is one of the things that the financial press loves doing as they start to pick over the body. It's like, well, this doctor said he was okay. This is Price Waterhouse Coopers. Now,
we didn't see
one of the funny
at
things about all of these big accounting firms is that they have a China. So if you look at Price Waterhouse Coopers, there's like a China part of it, and then there's a whole rest of the world part of it. And so they've got, obviously this is their China part, and they have different rules for them because the Chinese have made it very clear that even though they're in the WTO, they're not going to play by the same kind of rules that we do. So and we let them get away with it, but that's a whole nother thing.
So basically what you're saying is the Price Waterhouse Coopers is very much like trying to get a cat to look at a gecko out on the window. You point their face to it and they're like, what, look at everywhere else but.
Yeah, there's that. I mean, to me, this is, and I could go on a rant here about the opacity of Chinese financial statements and how the world has basically allowed them to hide stuff and to not have. I mean, I'm not saying that I mean, we've had our share. We've had Tyco, we've had WorldCom, we've had Enron. I mean, we've had deals where major accounting firms in our country have just been completely out to lunch. The thing that is with China is that there's not even an opportunity for them to even know that they're out to lunch. So somebody's going to be on the hook and they're going to look bad. But that's the risk they're taking by doing work over there, because at some level they have to know that they really don't know. And yet they're being paid to say that we know. Yeah.
We know everything that they'll tell us that we.
So anyway, here's our obligatory shipping note. I thought this headline was awesome. So just in the port of Los Angeles, there's enough containers that if you laid them end to end, they would get to the Mississippi River from Los Angeles. Think about that.
Well, hell, that's the most interesting thing of the week, dude. That's awesome.
That is okay. We'll call that the most interesting thing. Another somewhat shipping related, but we were talking about these disruptions to the supply chain. Shipping has been a huge disruption. Hurricane Ida really tore up the Gulf of Mexico. I mean, it did a lot onshore, but it did a lot offshore. Yeah. And this is a major thing because Royal Dutch Shell is the biggest player in the Gulf of Mexico. And this facility that has been affected, this is 200,000 barrels a day that's gone offline, which is it's not huge, but 200,000 barrels a day would be the size of a decent refinery. So it's something that's off. And a lot of times, regular viewers will know, and we'll show graphs of oil production, and you can see when a hurricane comes through that there's a little blip and it comes right back up. And so a lot of times the markets are kind of, inured to the idea that, things will bounce back quickly. And when they don't, such as this, it's kind of newsworthy. So this is, multiple months of 200,000 barrels a day not happening. You multiply 200,000 barrels a day by, say, 100 days to the end of the year, that's 20 million barrels. So the other thing is that with these supply disruptions, is that it's supporting the price of oil. Even as we've had some slowdowns in the rest of the world, the price of WTI as of a few minutes ago was like $73 a barrel. Yeah, it's higher than it was pre-COVID, and it's higher than it's been in a few years, and it's near the high for the year. And one of the reasons is that this supply is offline.
Yeah.
Did have to come up with a graph about shipping, even if we, I thought this was interesting because very sharp-eyed viewers would know that this is an update of a graph that we just showed 2 or 3 weeks ago. And what I wanted to point out, which is just amazing, is I think when we showed it, we were right here where this arrow is when I put this graph out 2-3 weeks ago, and we're already up here. I mean, even in just like a couple of weeks, I mean, this magnitude right here is about 1.5 of these horizontal rows. And if you look over here, it's like as thick as like the entire backlog was for a good bit of the time in normal times. So, I mean, when things get extreme, you're like, oh yeah, it's still going up. But you measure the magnitude of from there to there, and it's a lot. And it's really parabolic.
And ships at anchor as well.
Yeah.
At least if it's at berth, okay, they're getting unloaded and everything else. But at anchor, they haven't even gotten to the port yet. They're just sitting around outside waiting to get in.
In fact, there was another story for people who love shipping stories. There's so many ships out there that there's not that much good space for anchorage. And these are big ships. And so they've taken up like all of the anchoring space. And I read this story, there's like about 15 of them that are just drifting. They can't even anchor. There's no room to anchor.
We just keep driving around.
Anyway, we did get some good news this week. We've been a little bit concerned this summer about the housing market. That had been a real driver of the real economy for definitely the latter part of 2020 into the early months of 2021. And then kind of in late spring, we started to see a real lull. But this is the second straight strong month in a row. The housing starts number, it came in well above consensus, and we have, our familiar cadence. The prior number was revised higher. The actual number comes in above consensus and above the prior revised higher number. This number was close to the top of the range, and the permits number, which is a peek into the future, was above, same thing, but above the top of the consensus range. New home sales, same thing. Prior was revised higher. Consensus thinking it would sag back. Got a number that was higher than the prior revised upward and above the consensus range. So both of those in the real estate space, obviously. So really good because of how much of an impact in so many ways that real estate has in the rest of the economy. And then leading indicators, and this is a really strong number. The prior month over month was 0.9%. Now they did revise that down a little bit, but they thought it would come in the middle of this range, and actually came back in to equal what it had been last month and ahead of the consensus. So leading indicators are actually do a pretty good job. They started when I was a kid in the early 70s. And I was actually kind of a nerd to be even interested in stuff like this, but they were like, we need to see the future. So they came up with this mix of leading indicators. And if you look at the history of leading indicators, they do a pretty good job. They really do. People, if they miss something, it's just, there's maybe some outrage, but by and large, the leading indicators, if you see numbers like this, we got a pretty good glide path for at least 5-6 months. So just keep that in mind. But back to so we were talking a little bit about supply chain disruption. So we've got the shipping situation that's causing supply chain issues. We've had the hurricane that's caused supply issues with petroleum. And then we have the chips situation and how that's affecting the automobile market. So hat tip to Morningstar, but I watched a presentation this week from a Morningstar auto analyst, and he made some fascinating points. The first was, look at this used vehicle index. Everybody's I'm getting unsolicited emails for my truck like every day. It's amazing. I'm amazed at, I guess it's pretty easy to find out what kind of vehicle I have. But, it's not just my dealer, which is usually what it used to be. The dealer would send you, which is just a veiled way of getting you back in because they want you to trade up. But if you look at this, think of this as a stock. These are used cars. This is a stock. It's just meandering along from 1995. It was like 104 up to about in early 2020, about 144. And then you see the COVID drop, and then kaboom! Boom! This is just absolutely stunning. And what's the reason is here's the actual this is what this SAR that they use is seasonally adjusted automobile rate, which is like what their what the annual number of vehicles sold in the United States is. And so you can see that we were running about 17 million. That was just kind of standard. And then we had the COVID drop off, then we had the recovery. And you can see that we had even recovered to be better than pre-COVID. But this decline here, this is all not because people don't want to buy cars, it's because they can't. And they can't buy cars because the car makers aren't making them. And the car makers aren't making them because, this is hilarious. I just got another email. I see it right here. Another email for my truck just came in. That's hilarious. But anyway, this decline is, this is like a recession. You've seen that we've lost 5 million, an annual rate of sales of new car sales has dropped by 5 million since January of this year. Actually, I guess that's March. So this is a recession. This would be, if you were looking at the United States and what happened during a recession, you would expect to see something like this. Not during an economic expansion like we have. Yeah,
but it's a supply recession and not a demand recession, which is
exactly
weird.
And because the demand recession is like, okay, we can't get them here, we're going and paying up over here. That's supply and demand right there.
Well, that was like I said last year. Actually, it was earlier this year. I've got a 2010 truck, and I'm like, it's getting to the end of its I was looking for something new. Maybe we'd get something this year. And then I was having some engine problems, and I started looking at, okay, can I get another used vehicle or something like that? Because you couldn't really get your hands on new ones. And I start pricing out used ones, and they're worse than mine was. I mean, there's, CarMax was selling stuff for, 150,000 miles, $30,000 for a Ford F-150. And I'm like, I'm just going to replace the engine in mine. I love my truck. It was $10,000 to replace the engine and the rear end, and now I've got a truck that's probably going to last for 280,000 miles. So,
I mean, I have an F-150 and I love it. But the funny thing is that, like, I have a 2012, and I could sell it now for more than I paid for it.
Yeah, absolutely. I would not doubt that.
And I've been driving it for 9 years.
Yeah. And I love them. I mean, it's just they just keep going. And I'm like, I'm not going to pay you $30,000 for a truck that's a little bit younger than mine, but has 170,000 miles on it. You're crazy.
And here's why. If you're interested in a pickup, now this, I realize I try to blow this up as much as possible, but if you want it, things are not going to get better for pickups anytime soon. So we'll just look at the F series over here, this column. So this is in terms of, and I hope people can see this, this is days supply of inventory. So back in 2019, the F series days supply was basically, there was around 3 months. You can see that there's some 80s, 90s, and even 106 days worth of supply. In 2020, we started out the year, with almost 4 months, 116, 118. Then you got out into COVID, and they cut production. So you go from April to May, we went up from 118 days to 72, and then into the 60s. So you get into 2021, we started with F series having about 60 days worth of day supply. We were down to 31 by June, and then the most recent figure in August is 36 days. So basically, there's 1/3 of the amount of inventory that there was at the beginning of last year.
And not for want of building them, because they've got them sitting in parking lots everywhere because they can't get the chips to get in there and get them going.
Exactly. And the chip shortage is just like shipping. It's just, I did hear that, we talked about that one substrate factory that caught on fire. There's been at least 2 of them, and I think actually even 3 suspicious suppliers of chip, the materials that you actually put the chips on, these film makers. These guys, there was a big fire, and that factory actually came back online like last week. So that'll help, but there's concerns in the Far East. Some of those countries that make chips are either having COVID problems, or they have such strict COVID protocols that they're just not letting people go to work. And so, and we are still, I mean, Samsung is, I don't know how long they're going to take to figure out where they're going to put this plant. Last I heard, they were going to do it, they were going to put it up in Taylor, $17 billion. But I kind of compare Samsung with this dance that they're doing to Elon Musk. I mean, say what you want about Elon Musk, but he parachuted into Austin and said, that's where I want to put my plant. We got the permits. Let's go.
Yeah.
He had bulldozers out on that property like the next day. I mean, that thing's about done.
Yeah, it is. And it's scary how big the thing is. So
it's just, I don't know what that says about Samsung, but they can't move.
No. Let's think about it. Maybe we'll get it done.
So this is a easier visual to people to see, which is this is light vehicle inventory in the aggregate, and you can see that there was about 3.5 million, 3.7 million. This is the beginning going into COVID. How many cars were in inventory? And then you have the COVID. This was voluntary. This is the automaker saying, "Ooh, we don't know about this. We're just going to cut production." And then it was like, okay, things are going okay. And then somewhere around in here is when the chip shortage started. And then you just look at the drop off in inventory, and we're running down here. This is a over 50% off of this number up here. And you can see these bars are still going down. And what was interesting that Wards and Morningstar talked about is that they only really started keeping comprehensive data on auto inventories in 1985. And this is the lowest that they've ever seen. And so they're thinking, just anecdotally, thinking about like stories maybe their dads told them and stuff about, but they're thinking it maybe back to World War II that it's been that long since we haven't had inventory. They didn't make cars in World War II.
Yeah, they didn't make cars for 4 years. So.
Anyway, at least since 85, but many decades probably before. And then last but not least, this is maybe another candidate for the most interesting thing, because we've been talking a lot about beginning really in March of this year, right around the end of the month, that the interest rates peaked and the 10-year note was up around 1.75%, and then it just started coming back down again. Well, lo and behold, after spending a few months at around 1.25, just in the last day or two, we're up about 15 basis points. We were at about 1.3 at the beginning of yesterday, and now we're at about 1.45. Just something to think about. The market's digesting. Is this inflationary? Is this possibly related to some of the ripples going through the bond market from Evergrande? Is it related to the budget negotiations in Washington, which are beyond the scope of this discussion today? It looks like, I'll just say this, I think we are going to see a government shutdown. I don't know, days, weeks, but I think that come September 30th, I don't think there's going to be a deal, and I think we'll have a shutdown, and we'll see how that affects the Treasury markets. So this could be, probably a driver of this as well. But then we go back to what we've kind of talked about a little bit, which is, the markets are climbing that wall of worry. We had that one bad day from Evergrande on Monday, and then we came right back. And part of it is that there's a lot of fear out there right now. And when everybody's fearful, it's hard to get things to really get a lot more fearful. So this is the proverbial wall of worry in my book. There's a lot of people that have positioned themselves, and the other thing I was going to say is that we're near the end of September, and a lot of people don't realize it, but September is statistically the worst month of the year for stocks. October is second, I think, and a lot of people remember all the major crashes in October, 29 and 87 in particular. But while October's gotten spectacular, September has had more of a grind of negativity. And historically, again, getting back to the cadence of things, if you come through September okay, you're pretty much good through till Christmas. So what's that mean for stocks? I thought this was fascinating. So And it had been, it's been at least 6 months since we've looked at charts with the good old advanced decline line. So, in the absence of having a lot of economic charts to talk about this week, I thought, let's look at this. So this is the NASDAQ Composite Index for the last 4 years, beginning of 2017 up until the present. So actually, I guess this is a 5-year chart. What I find interesting is that you had this period here from early 2018. You take out these few months in late right before COVID, and then you got the COVID crash. But you could pretty much draw a box around this area here. Now, what was happening here was this is the advanced decline line, which is kind of an overall health. This is advancing issues minus declining issues. And what you want to see is this line rising along with a market, which indicates that it is not a narrow market, but you've got a lot of participation. This market was going sideways, and the advanced decline line was tilted downward, and it really bottomed, right here with COVID. And then all of the money janked into the market, and it just exploded. But what I wanted to highlight here was this divergence that's developed since the early part of 2021. When we hit this peak in early February, was when the advanced decline line peaked. And since then, we're seeing a degradation in what would be called the participation in the market, while the averages itself keep rising. And what does that mean? It means that there's just fewer dogs pulling the sled. And those dogs that are pulling the sled are the big ones. And so when things are getting narrower, that's a sign of concern. And what I find interesting, and we've been talking about whether or not we're going to have this rotation to value stocks. We were talking about it earlier in the year when interest rates were rising. And then lo and behold, as I showed you a little bit ago, interest rates are rising again. And that has a negative effect on the tech stocks. And so this is just how all this kind of swirls together, that maybe the tech area is showing signs of topping out. So what do the S&P and the Dow look like? Well, here's the S&P. That's just like a ramp. I mean, this is the advanced decline line, just straight up strong. I mean, that is just low to high. So, I mean, it hardly budged during this. You can see that during this waterfall drop from COVID, this is what the advanced decline line did, and then it just kind of shouldered on. So the Dow looks the same. The S&P is kind of the market. NASDAQ is growth, tech, and then the Dow is kind of value. So you look at the value side of things, looks a lot like the S&P. You got this straight up advanced decline line ramp. The COVID waterfall hardly did anything to it. This is the Black Christmas of 2018, little bump here. But anyway, it just seems like where I would probably end up is that the market with the way that we're seeing the bond market and interest rates starting to rise, could be a rotation back into value. Certainly these technical indicators would support that. And so that's about it.
Okay.
The most interesting thing I just can't talk about. Obviously it's the border. Everybody's been seeing what a disaster that is, and I just can't talk about it. So we'll just leave it there.
Yep. Well, we already picked another one, so that's fine.
That's right. Yeah, we do have
shipping containers across the country. So.
Yes, containers across the country, or
at least halfway across the country, and probably there's enough of them in the other side of the country to reach the other direction. So.
Yeah, there's a few news stories out now about what's going on in Jacksonville and Brunswick and Wilmington and some of those ports, Charleston on the East Coast.
Crazy.
Anyhow, that's what I had this week.
Good. Well, thank you, Tom. I appreciate it.
You're welcome.
Yeah. Once again, folks, we love to hear from you. So if you have any questions, please put them out there. We actually had a question today that led to the conversation about Evergrande. So it was kind of timely with what Tom was talking about. So please, we'd love to hear from you. Please give us some questions, and we will get those on an upcoming show. I thank you for joining us on here, and we will see you guys next week.
Give me what I want.